So hi and welcome. I'm Jo Tonetti, Senior Financial Advisor at WealthMed, coming to you from our homes rather than work. And another WealthMed webinar. Thank you for joining us. If it's your first one or number that we've done in the series, we've done these sessions to help keep you informed, up to date, and most importantly engaged in your financial world. We felt that at a time when in our own country and countries around the world are starting to ease their restrictions, return to some form of normality, leave our homes and see each other again, that we should reflect on where we've been, what we're experiencing right now, and what perhaps we should be prepared for that might happen next. So they're big questions, not one that we can answer on our own. So we've invited to have a chat with us this morning Tom Bignall from Mason Stevens. He's zooming in to join us from Sydney. Good morning, Tom.
Jo, thank you very much for having me.
Pleasure. Look, we want to keep this pretty casual, so we would invite you to ask any questions throughout the conversation. Just post them in the chat box, and Gemma will let us know the questions as they arise. So, let's just dive straight into it, Tom. We've had a really challenging time, easily the most difficult time, for the world and markets for some generations. And what I'd love to hear and know from you is, what should our long-term investors be thinking right now, and what would you consider to be a silver lining?
Thanks, Jo. I think look, you're absolutely right. It has been a very, very challenging time over the last couple of months. I think if we go back to sort of Christmas and early January, we had markets which continued to rally, and equity markets I'm talking about realistically here, continued to rally strongly in 2019. And we got to Christmas and markets probably looked a little bit toppy and a little bit expensive, but really last year had really been driven by the risk on trade, where a lot of money had been poured into equity markets. And it continued and continued. We follow the money flow very closely. And ironically, that continued into January and took markets to pretty high levels by early Feb in terms of PEs and where they were trading compared to their long-term average. The US market got up to sort of 19 times 2020 earnings, and its long-term average is about 15.5. So it was trading at pretty reasonable levels. And then we got the big hit as the COVID-19 pandemic started to move out of China and dissipate across the world very quickly. And what you saw was a massive rush for the exit, where everybody really pulled out some risk arb trade, hedge funds, some levered hedge funds, any levered positions. All went for the exit very, very quickly. And we saw something in markets that we've never seen before, which was this phenomenal volatility, increase in volatility that culminated in the first 2 weeks of March, of markets falling such a big amount in such a very, very short space of time. And it was a rush for the exit. It was an unwind. I think there was more leverage in the system than what people had expected, and the markets bottomed quickly and then bounced just as quickly. I think partly because everybody was in shock at the severity of the bounce, and things bounced back. A lot of people have said, this is what can we learn from the GFC or 2009? For this sort of crises. And I think it's really important to remember that the GFC was a financial crisis. This is a health crisis, and the results of which the likes of which we've never seen before globally. We are in really uncharted territory, and people are feeling as they go in terms of their response and what should be happening. We've never seen unemployment numbers, PMI numbers, general economic numbers like what we've seen over the course of the last month and what we're likely to see over the course of the next 2 or 3 months. So there is no playbook where we can say, well, this is what we should do when this happens, because we're dealing with a completely different crisis in that.
So Tom, for our long-term investors, when we experience significant and, as you say, unprecedented market volatility like this, what should they be thinking right now?
Well, I think what's really interesting that's happened over the course of the last 3, 4, almost 5 weeks is the way the market's thought about it is that it's actually looked through, yes, we know we're going to get some bad news, and yes, we know a lot of people have lost their jobs. And the jobs thing's really interesting because, they're a long way behind in the count, so we don't actually really know that, the full extent of what the unemployment rate is to a degree. And second of all, there's a term that's being used now by most companies in the US, which is to furlough workers. And no one's really sure if that means to put workers off for 3 months and then bring them back on, or to make them use leave, or to actually that they'll never come back. And there's a little bit of uncertainty there. And I think the markets have said, well, actually people will come back, and pubs and clubs and restaurants and bars and all that sort of thing will reopen, and the industries will start to find their feeding, and people will be employed. But nobody has any real certainty around the timing of that. We're starting to get some places opening around the world. Staggeringly, Germany announced today that they're reopening the borders as of tomorrow, which I just find fascinating, or fascinatingly stupid. I'm not sure which one. So we're still in this little bit of time where we kind of don't know the full extent of it. So what markets have done over the last 5 or 6 weeks is look ahead, and they've said, we've never seen stimulus like what's been put forward before. Some $16 trillion plus of fiscal and monetary support has been injected in 8 weeks into the US economy. We've never ever seen that before. And of course, stimulus normally takes somewhere between 6, 9 months to really flow through into the economy, and the economy start to see the benefits of it. So the market said, well, yes, it's really bad right now, but actually we're seeing enormous government interaction and stimulus, and we know that's going to boost the economy and help things get back to normal. So we're going to look through all of this and actually look at 2021, which should actually be quite good. Companies will recover, and so we're comfortable to go back up and see through that. Now, I think that's all good and well, and it potentially is the right and mature thing to do. The problem, of course, is that we don't know the full extent of what this is going to do and what it means. And I think the market probably in the very short term has got way ahead of itself by heading back to levels that we saw at the beginning of February before all of this came unstuck. And really interestingly enough, we've seen a reversal of that the last 2 nights. And I know 2 nights don't make a trend, but certainly the tone in the US has shifted greatly from the rally in the last few days to now. I think we're going to see a bit of a pullback, which is natural.
Yeah. So what other indicators should we be on the lookout to know that this is a market that is improving?
It's really hard because normally you'd point to sort of key economic indicators like unemployment rate and manufacturing and exports and so forth. But we all know that because we all know that all of those numbers coming out in the next 3 months will be horrific. We're setting records every month with worsening PMI or manufacturing or unemployment or whatever the case may be. And it's likely that will continue because we have never ever seen a global economy shut down the way that we had it shut down. And now it needs to reopen up. The other thing too, interestingly enough, is that we've just gone through a US reporting season. So in the US, they report every quarter, and we just had Q1 earnings. So that's obviously January, February, March earnings. Now, really, the US wasn't really hit very hard in terms of a shutdown until mid-March when they really started to shut down. Even then it was a bit slow. So what we've had is we've had a lot of companies say, well, Q1 was okay. If they had bad results, they blame it on coronavirus. If they had good results, they temper the market. The big thing that came out of the quarterly earnings in the US was we don't even know where to guide you for the next quarter. We don't know what our earnings are going to be. There was a thematic that came out because we're now basically 95% through all of the companies that have reported, that they did see a lot of companies saw a pickup in activity in April. So second quarter earnings will be worse than first quarter earnings. But one thing that we'll look for will be in the commentary in that, and we'll see that probably in about July and August. Look, at the moment, in terms of indicators to look for, probably, you know, where we can get commentary out of companies talking about what they're seeing from an earnings point of view is probably pretty powerful. And of course, this whole furlough, whether people have been laid off and will join the unemployment line, or whether they've been furloughed and they're getting a government check. So as those numbers in the next 2 months start to become a bit clearer, that's something key. I mean, unemployment is really going to be the key of this, and how it goes.
Yeah. Winners, I mean, winners and losers in difficult times. Are there particular, themes or sectors, Tom, that you believe we, will come out as a winner?
I think we've already seen to a big degree that big tech, the large tech companies in the US, and if we look at the major players over there, your Apple, your Amazon, your Microsoft, your Facebook, in Asia, the Alibaba, the Tencent, these guys have come out of, have gone through, whilst they drove the market higher last year, they've come out of this malaise certainly ahead of the pack. And to a degree, you've almost got a bit of a two-tier economy, because those companies are now, this whole pandemic and the last 3 or 4 months has actually strengthened their position in all of the markets that they do, because now more and more people are doing exactly what we're doing today. And importantly, people of all ages have been forced, whether they like it or not, to use technology extensively over the course of the last 3 months. So whether it's online grocery shopping, whether it's doing Zoom meetings or Microsoft technology, everybody is doing it a lot more, and it will reshape how people communicate, how companies operate. So there is no doubt that those companies will come out stronger than they were before. Interestingly enough, those 5 companies, the big 5 FANG stocks, and Google, I include Google in that as well, now make up 22% of the S&P 500 index. Now that is an enormous proportion of the US market, really controlled by 5 companies or led by 5 companies. In fact, 2 days ago, those 5 companies, the value of those 5 companies, the market capitalization of those 5 companies was larger than the entire Japanese stock market. So these companies are getting bigger. They've had phenomenal earnings growth over the last 5 years. I don't think we're going to see that same earnings growth happen over the next 3 to 5 years. I think they're going to trade probably more like bonds. You know, you're going to get an annuity income out of these sorts of companies. They've got phenomenally robust balance sheets, huge amounts of cash. I mean, Apple, for example, has $140 billion US in cash sitting outside of the US, which is about 90% of its cash reserve. So these people have been very, very clear winners. And then, you know, the losers, obviously, what's happened in energy markets, so energy stocks, and that'll take quite a while to flow through. Travel and leisure stocks, whether you're Royal Caribbean Cruises or whether you're Bookings.com or Flight Centre or Webjet, you know, that they will take some time to come back. With when you have an event like this, it certainly will draw some consolidation. So we'll probably see some strong M&A, mergers and acquisitions activity over the course of the next 3 or 4 months. I think that's another indicator. When you start to see more M&A, it means that companies have got a bit of confidence that they're prepared to go and buy another company. And of course, interest rates are going to be so low for so long. So we're in a low interest rate world. It's going to be, you know, we have aging demographics globally. So people will continue the insatiable search for yield. And when you buy a bond and it's only giving you 3%, you can't put your money in a TD anymore because it may not give you anything. At some point, that shift will come back to equities and people will be looking at equities. Unfortunately, it's hard because we've gone through, most companies have cut dividends or suspended dividends. In the US, for instance, all the banks have been asked not to pay dividends. They're not paying dividends. So we don't have that dividend certainty that we had 6 months ago. But that will come back. That'll come back as earnings come back and as markets stabilise. So here closer to home, I think, you know, obviously we've seen a surge in sales demand and so forth from your consumer staples, your Woolworths and your Coles, and your Bunnings, in Wesfarmers and so forth. So I think you'll continue to see that. I think there's a bit more to play out with the banks. We've just come out of the banking reporting season. And there have been some winners there and some losers there. So all in all, our banking sector is in very, very good shape, and far better shape than it was in the last crisis that we had 10 years ago. All in all, the Australian economy is in pretty good shape, albeit we've now just got a lot more debt.
Yeah, and I think it's a bit of a purple patch with interest rates where they are, even, you know, pre-COVID, but right now, and you know, for our wealth accumulating clients, this presents, you know, an amazing opportunity, you know, to use the bank's money, it's cheap, to push themselves forward, you know, at a time when, you know, if other people are running away, they're in a position they can keep things going forward. And I think, you know, you've touched on quite a few silver linings there, you know, be it that Nan and Pop can now video chat, that potentially when this all eases, that, you know, people might be coming to the Sunshine Coast for a relaxing holiday, which, you know, is great news for our local economy.
Just on that, Joe, I mean, I think travel's really interesting, and you know, we're obviously starting to go through across all the states now the reopening. They announced yesterday here in Sydney that bars, well, pubs with restaurants in them can reopen, and pubs and bars can reopen. Ironically, it's a bit of a Clayton's open because you can only have 10 people in there. So I don't know how that's all going to work, but it'll be interesting. So you know, because of our island-like position globally, us and New Zealand, we are actually in a very strong position now to enable to open up the states and let people travel through Australia. I mean, it's my view, who knows, but I don't think our borders will be open to international travel before March or longer next year at an absolute minimum. And nor probably do we want to, because particularly if there's any sort of second outbreak, then that'll be blown out. But if we can open the borders between us and New Zealand, and if we can open the borders of the states, then that'll go a long, long way to reviving the economy, because we are a nation that travels overseas in holidays, and now we can't. And it'll be great for that to be spread across the economy here domestically.
Yeah, no, I often when I travel overseas and I come back home, I think, gee, we really are the lucky country. So now more people will hopefully be able to get out and see that for themselves.
Yeah.
I might just pause for a moment and just check if we've had any questions come through, Gemma.
No, we haven't, not as yet.
Okay, cool. Well, I might sort of end the conversation, Tom, on you know, a bit of a future state, and ask you, you know, my kids today ask me, you know, pre-COVID, what was the GFC, and I found myself, you know, looking for YouTube videos to explain to them what the GFC was. So, you know, it had me thinking, if, you know, in 20 years time, when, you know, you're sitting on the porch, enjoying a cold drink or rocking in your rocking chair, and your grandkiddies say, Pop, what was COVID-19? What would you describe? How would you describe that to them?
Boring. We all had to stay at home. I think it was the first time in my lifetime, in probably most of our lifetimes, where we've actually seen the global economy shut down and not move. And people were locked inside and nobody was on the streets. And you look at the footage that we saw from, or still see from the UK or from Paris or New York or any of the major cities, of just the complete lockdown. I think it was and it is incredible. I think it gave everybody a time to reflect in terms of how and what they do, and how, you know, we've all been forced to stop and have a good think about what we do and how we do things. And I think there'll be many benefits and differences in the way that we live our lives that we come out of it. Of course, as things open up, everybody will sort of, you know, rush to do things that they used to do. But I think over time, companies will adapt and change, and people will adapt. And I hope it brings out the best in people. So it'll be interesting to see.
Wonderful. Thank you. Thanks, Tom.
I've just got a little question, Tom and Laurie, just to maybe comment a little bit on our portfolios and maybe our house view, and a couple of things that we may have done that people might be interested in.
Yes, well, I can run with that. As Tom said, the short term is probably not so rosy. We suspect that the markets will be in a bit of a trading range from about its recent high point last week through to, you know, down towards its recent low point last month. So we've taken a little bit of a conservative approach, or more of a defensive approach, in the direct equity portfolio. Tom mentioned the banks are in good shape. We don't see a lot of growth in them in the short term, so we've got very little exposure to the bank stocks. And barring a meltdown, economic meltdown, or a big property slump, the banks will come through it fine. We've certainly had exposure to health stocks, healthcare, Nanosonics, Sonic Health, and we'll probably consider CSL in the future if we can buy it at an appropriate price. And more defensive stocks like Telstra, and a bit more cash at the moment than we would normally have. So it's certainly taken a defensive stance, but that could easily change with some positive news coming out of, you know, the virus vaccine, or some form of cure. And as Tom also alluded to, you know, opening up the Australian economy, you know, in conjunction with NZ will be a big step forward. So we just, you know, sort of, I guess, fingers crossed we don't get a second wave, because that will potentially be a disaster. But now, if the short term, I just want to reiterate for our clients, the short term, you know, we don't know. This is unprecedented, obviously. Medium term, you know, the markets always revert to the mean, and if we've got a reasonable economy and you know, manage the debt levels, governments, the markets will be fine in the medium term. As always, history tells us that.
Wonderful. Thank you for joining us. You know, we will make this recording available as a link. If you know you want to listen again, or if you know you've missed the session, it will be available for you to enjoy at your convenience. So thank you, Tom. Sorry that it's not sunny in Sydney today.
No problem at all. Thank you very much for having me.
Yeah, hopefully you got a bit of sunshine from the sunny coast into your office. So
Absolutely.
Really appreciate you took some time out to join us, and to our clients online, thank you also. And have a lovely day, and by all means, if you've got questions or you just want to chat, reach out to your advisor at WealthMed, and we're here to help you.
Thanks, Tom. Thanks, Laurie.
No problem. Thanks very much.
Joe.